Unlike many investments where you may owe taxes each year on interest and dividends and capital gains, the earnings inside the annuity generally will continue to grow without being taxed each year. Welcome to another episode of the Simply Retirement Podcast. I am your host, Eric Blake. Joining me as always is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I'm well. So over the last couple of episodes, we've been building this foundation on understanding annuities. And just so we get out of the way, episode 4, this is episode 3 of the series. Episode 4 is going to be a pop quiz for you to see how well you've...
You're going to get that red pen out now.
And it's one of those interesting things with annuities. And part of the reason I wanted to do this is, when we're talking about, a lot of our audience have gone through these emotional transitions. Even retirement itself can be an emotional transition. But if you've gone through a divorce, if you've been widowed, there's all these different emotional things that are happening at the same time that you're making these big financial decisions that could be impacting your retirement. And I've just found over the many years I've been doing this, that annuities kind of pop themselves up here and there in these situations as well, because sometimes they have these almost too good to be true type factors that, whether it's the guaranteed income or guaranteed this or whatever it might be, where annuities sound reasonable in the circumstances, but once you realize, hey, I didn't quite understand how this worked, or that's what I thought it did, but it actually does this. And that's why I wanted to do the series of episodes, is just to provide some clarity around annuities, where they fit. And again, always coming back to making sure we're asking the right questions to decide, is this the right tool or product for my specific retirement plan?
Okay.
So in episode 1, we answered the very basic question of what is an annuity. We talked about an annuity being a contract with an insurance company that is designed to provide certain benefits, whether that's guaranteed income or principal protection, tax deferral. In episode 2, we explored the different types of annuities, why someone might choose one over another, depending on what they're trying to accomplish. And in this episode 3, we're talking more about the taxation. And this is the part that really does become confusing when we're talking about annuities as well. And that question of how are annuities taxed?
Mm-hmm.
And it's one that often sounds more complicated than it really is. But by the end of today's episode, what I want to do is help you understand basically 3 simple questions regarding how annuities are taxed. Okay. Number 1 is, where did the money come from? What was the source of the money? How do you plan to receive the money back? And then why are you buying the annuity in the first place, right? If you can answer those 3 questions, or at least understand those 3 questions, it's going to take you a long way in understanding the taxation of annuities. So let's go and get started. If you're ready to get into another fun tax topic like I am.
Here we go.
So last week, we talked about the difference between an annuity as a concept, as a financial concept, and annuity as a financial product. And I used the brilliant comparison, right, of the restaurant. If you're hungry, you either go to a restaurant and all you got to do is pick what you want. That's all you got to do. Mm-hmm. And that was the kind of the financial concept, the payout. Because one of the questions you had is about, well, it sounds like annuity is just a regular payment, a scheduled payment of income, right? And I talked about, it's actually, when you think about the annuities and the way we're referring to them in this episode series, is as a financial product where you've got to make more decisions. So when you're thinking about a product where you've got to make decisions, it's more like if I were still going to eat, but I'm going to go to the grocery store and pick the stuff that I want. I choose what I want to eat, but then I've got to pick the ingredients. I've got to decide how long is it going to be before I'm going to eat, all these different things, right?
It's going to take longer that way, right?
It's going to take longer that way. When you think about the grocery store concept, the other thing you have to decide is, of course, not only what the ingredients are, how soon you plan to eat, whether you're cooking for one person or an entire family, but also we have to think about, how am I going to pay for all these ingredients?
Okay.
Right? How are you going to pay for them? You might use cash. You might use a debit card. You might use a credit card. The groceries didn't change. Only the source of the money changed. And that's very similar to purchasing annuity. And before we talk about how annuities get taxed, the first question is simply, where did the money come from that you're putting into this annuity contract? Okay. So for many retirees, the money comes from a retirement account. That might be an IRA, it might be an old 401k, or some other type of retirement plan. And then for others, the money comes from savings that they've already paid taxes on.
Okay.
So that might be a savings account where they built up a certain amount of money in their savings account. Might be a brokerage account or just an investment account. It might be life insurance proceeds that you've already received. It might be an inheritance. It might even be money from selling some other investment, or even maybe you sold your house, or maybe you sold a business. These are all examples of money outside of retirement accounts.
Mm-hmm.
So the first question, where did the money come from? That is the first factor in determining how an annuity is going to be taxed. So I want to start with retirement accounts. So if you've been saving money into a retirement account for many years, there's a good chance a large portion of your retirement savings is inside of an IRA or maybe even an old employer plan, okay? And sometimes people assume that purchasing an annuity inside of one of those accounts changes how the money is going to be taxed, okay? And in most cases, it doesn't. So here's the easiest way to remember this. It's the investment that changed. The tax rules generally do not change when we're talking about a retirement account. And I've used this analogy before, but if you think of a retirement account like an umbrella, okay, the umbrella determines how your money is taxed, okay? In other words, the umbrella is protecting your money from Uncle Sam getting to your money, okay? Just like it would the rain. So under that umbrella, you choose your investments. You might choose mutual funds. You might choose stocks. You might choose CDs. You might choose an annuity, okay? Changing the investment doesn't change the umbrella, right? So it's still protecting your money from Uncle Sam. You're just deciding how I want that money to work underneath that umbrella while it's there.
Gotcha.
So why would somebody choose an annuity inside of a retirement account? Because it's not because that it is any additional tax benefits you can receive. It's because of what they want that investment to do. Okay. Maybe they're looking for guaranteed income. Maybe they're looking for principal protection for a portion of their retirement savings. Maybe they're looking for more predictable retirement income.
Mm-hmm.
Or perhaps they're just trying to reduce the impact of market swings that could have on the money until they get ready to begin spending it. But those are all planning decisions, right? And in fact, the guide that we've been talking about as we've gone through this series, that's one of the questions that I think is really impactful is, why am I considering an annuity in the first place? What is it that I want that money to do before I get ready to use it? So if your goal is guaranteed income, principal protection, or some other planning objective, then you can decide whether an annuity is the right tool to help you accomplish that goal, okay? Because an annuity inside of a retirement account, the same tax rules apply to your other retirement investments. It's all the same, right? For withdrawals before 59 and a half, the entire balance may still be subject to a 10% IRS penalty unless there's some exception that applies. So you don't get around that. Later in retirement, you still have required distributions or RMDs, right? Those aren't annuity rules. Now there is actually, and I'm going to create a little confusion here, I hope probably, but there is an age 59 and a half requirement that does apply to annuities, but we're going to talk about that here in just a little bit. But in general, an annuity inside of a retirement account, it's the retirement account rules that apply, right? The annuity simply became one of the investments inside of the account. So again, if you remember one thing from this part of today's episode, the retirement account determines how your money is taxed. The investment you choose inside that retirement account determines the role that it plays inside of your retirement plan.
Okay, I got the first part.
Okay.
That it's going to be, if it's already taxed, it's not going to be taxed again, I assume is what you're saying. But if it hasn't been taxed, it will be taxed like it would for an IRA or a 401k.
So let's step back into what I said originally.
That wasn't the part I had a problem with.
So think about where the money's coming from. The money that I'm putting in that annuity, what's the source?
Right. If it's 401k.
Right. So if it's 401k or IRA, it's the rules of the IRA or the 401k that determine the taxation.
Right.
Not the annuity itself.
Okay. So you're still going to have to pay taxes on that when you withdraw it.
Right. So any money that comes out of it, doesn't matter what it's sitting in, whether it's an annuity, a mutual fund, a CD, when it comes out of that IRA, it's going to be fully taxable at whatever tax rate you're at, whatever your ordinary income tax rates are.
Okay. Now, what's that second thing that you said?
So the second part is saying, okay, now we're going to get to that now. So we're talking about if the money doesn't come from a retirement account or 401k or IRA, it comes from some other bucket of money that is already after tax.
Mm-hmm.
Again, maybe a savings account. Maybe you sold a real estate property. You sold something, you inherited money, right? Or you received life insurance proceeds. So money that didn't originate from a retirement account in some way, right? So now that's what we're going to talk about now is how does that money get taxed?
Okay. Yeah, I'm up to speed now.
Perfect. So when you think about one of the ways that people may purchase annuity, instead of using the money from a retirement account, we purchase annuity with money you've already paid taxes on. Again, savings account, a brokerage account, life insurance proceeds, an inheritance, another investment, whatever it might be. Now, those are all examples of money that no longer sit inside of a retirement account, or maybe never were in a retirement account. And this is a term that you might hear what's called a non-qualified annuity. And not to cause confusion by that term, the word non-qualified simply means where did that money come from? In that it did not come from an IRA or a retirement account originally, okay? Because you might also turn that term. So there's what we would call two different basic sources of money. Qualified, which means no taxes have been paid. Non-qualified, meaning it's already been taxed.
Okay. Gotcha. Non-qualified. See, it should be the other way around in my mind. You know what I mean? Because non-qualified I would think no tax, but that's taxed.
So it's tax. So that's where, let's say again, and let's use this example. Maybe this will help out a little bit. So let's give you an example. So suppose you invest $100,000 into a non-qualified annuity. Okay. So I pulled the money, $100,000 from my savings account.
Mm-hmm.
So I'm not paying tax on the $100,000 itself.
Right.
I might be paying some tax on the interest that it's earning. So if it's just in a savings account earning 0.5% or whatever it might be, you're still going to pay tax on the interest that you're earning, but you're not paying tax on the $100,000.
Gotcha.
Right? So that's non-qualified. I'm paying tax as the money's growing.
Okay.
Right? Versus qualified, if I have $100,000 in my IRA, I don't pay any tax until I have to start taking money out of there.
And if it gets to be $110,000 over a number of years, you have to pay on all of it.
Right, exactly. Yeah. So my example that I was going to use, so we say that we take $100,000, we put into annuity, and it grows to $130,000. Okay. If it's in an IRA, when I get ready to take that money out, let's say for whatever reason, I'm just going to take it all out. In an IRA, all $130,000 is taxable. Right. If I put that same $100,000 from my savings account into an annuity, and it grows to $130,000, the $30,000 represents earnings, but the $100,000 I've already paid taxes on it. So I'm not going to pay tax on the $100,000 again.
Okay.
Right. So it's only the $30,000 in earnings that I might have to pay tax on. And unlike many investments where you may owe taxes each year on interest and dividends and capital gains, the earnings inside the annuity generally will continue to grow without being taxed each year. That's what we talk about with tax deferral. Right? So eventually I may have to pay tax, but I don't pay tax until I get ready to use the money. Instead, taxes are deferred until I begin taking money out.
Okay.
Right? And so for many retirees, they may allow more of their money to remain invested and working for them over time.
So that's different from a Roth IRA because?
So Roth IRAs are tax-free.
Right.
Number one. So the entire balance is tax-free. Now, again, let me throw a big wrench into this conversation. So underneath a Roth IRA umbrella, again, think about the umbrella concept. The whole idea with an umbrella is we're protecting our money from Uncle Sam. Okay. However, underneath an umbrella, a Roth IRA umbrella, when I get ready to take it out, it's 100% tax-free as long as I've met all the guidelines and restrictions, right?
Even on the money that you've earned since it's been in the account. Right. Okay.
But if I wanted that with those withdrawals from my Roth IRA to be 100% guaranteed income, I could buy an annuity underneath that Roth IRA umbrella.
Okay.
So it wasn't the annuity that changed that impacted the taxation. It was the Roth umbrella that determined that it would be tax-free.
The annuity really never dictates anything when it comes to taxation.
Not inside of the IRA or Roth IRA umbrella. Hi, everyone. It's Eric. Hope you're enjoying today's episode. I want to take just a quick moment to share a resource I think you'll find really valuable. If you've ever asked yourself, how much is my Social Security reduced if I file early? Or am I eligible for benefits as a spouse, surviving spouse, or even after divorce? You're not alone. That's why we created our ultimate guide to women's Social Security success. It includes 6 of our most popular Social Security guides and checklists for women. Inside, you'll find a 2026 quick reference guide with key Social Security amounts and limits to be aware of, along with 5 additional guides and checklists to help you make more informed decisions about eligibility and filing strategies. You can download it for free at womenssocialsecurityguide.com. Keep it handy wherever you may be in the decision-making process. Now, back to the episode. I can buy an annuity outside of a retirement account as well. I can buy an annuity outside of an IRA, outside of a Roth IRA. That's the non-qualified component, right? So that's money I've already paid tax. So if I have $100,000, I can't just say, well, I would just want to put all $100,000 into a Roth IRA because there's contribution limits, right?
Oh, right. Yep.
So this year, for example, I can only put $7,500 if I'm under age 50. I can put $8,600 if I'm over age 50. That's the most I can put into a Roth IRA, right? But if I'm looking for some other source, again, am I looking for guaranteed income? Am I looking for tax deferral? What is my objective? It always comes back to what is my objective? What am I trying to accomplish with this money?
But with the non-qualified, funding of it, you will have to pay tax on any money that you make from the account.
True, but not until I get ready to use it. That's tax deferral. That's what we're talking about with tax deferral. I don't pay tax until I'm ready to use the money.
Okay, gotcha.
Okay. So again, and obviously eventually most people purchase annuity because they expect to use the money at some point in the future, right? So how that money comes back to you does affect how it gets taxed when we're talking about an after-tax or non-qualified annuity, okay? So let's start with withdrawals. So using our example I just used before, suppose your annuity has grown from $100,000 to $130,000. If you begin taking withdrawals before turning the contract into a stream of lifetime income, the tax rules generally treat the earnings as coming out first, right? So in our example, that means withdrawals would generally come first from the $30,000 that it's earned, okay? Those earnings are typically taxed at ordinary income. But once all the earnings have been withdrawn, those additional withdrawals generally come from my original $100,000 investment. Since I've already paid taxes on that money, those dollars aren't usually going to be taxed again.
Okay.
Does that make sense? So I put $100,000 in. Over 10 years, it grew to $130,000. I get ready to take that money out. Number one, I have to take the $30,000 out first. That's what we call LIFO, or last in, first out methodology. I've got to take my $30,000 out first. But once I've taken the $30,000 and only my $100,000 is left, I paid tax on the 30, but the $100,000 that I've already paid tax on comes out basically tax-free.
But if you keep it in there, it's going to keep accumulating.
It's going to keep a tax deferral. Exactly. So if I said, if I ran an illustration and said, okay, let me run some projections. If I wanted to start with $100,000 and I'm getting some fixed rate of return, whatever that might be, that says, well, if I leave it in there for 10 years, my $100,000 is going to grow to 130.
Mm-hmm.
But if I leave it in there for 20 years, my $100,000 might be 160.
Okay.
If I'm earning that same rate over the 10 years and then over the additional 10 years beyond that, so a total of 20 years. So same exact illustration, but then saying, okay, if I waited for 20 years, now my value is 160,000. I started with 100. If I start taking withdrawals, again, I've got to take the 60,000 first. It's going to be taxable, most likely at ordinary income. But once I've taken that $60,000 in earnings out, my $100,000 is left. I can take that out tax-free because I've already paid tax on it.
I got you.
So it's all about deciding how do I want this money to work until I get ready to use it, right? And that's simply one of the tax rules associated with taking money out early. Now, there is, back to, I mentioned the 59.5 rule for annuities, similar to the 59.5 rule with IRAs. So if you're younger than 59.5, the taxable portion of a withdrawal from annuity may be subject to a 10% IRS penalty, again, unless some exception happens to apply. So it's very similar to the IRA rules. But if I'm going to get tax deferral, basically what Uncle Sam has said, or what the IRS has said is, we will allow you to defer those taxes, but you have to defer them till at least 59.5, right? So similar to the same, so 59.5 with an IRA, 59.5 with an annuity, but it's only the earnings for the annuity. If it's an after-tax annuity, it's only the earnings that are subject to that 10% penalty, not my original investment.
Right. Okay. Got it.
Now let's connect something back to something that we discussed in episode 2, and we talked about this term annuitization. which I think for you was kind of what you thought about annuities in the first place. So, because you use the idea of, okay, if I win the lottery, I can take the lump sum or I can take lifetime payouts. The lifetime payouts is basically annuitization. It's the same concept, right?
Okay.
I've got a lump sum of money that I give the insurance company, and in return, they pay me an income for the rest of my life. That's annuitization.
Okay.
Okay. So that's when you exchange some, or that's when I'm exchanging some or all of my annuity value for a series of regular payments. So I give them $100,000. In return, they give me a monthly distribution of some amount, depending on how I structure the contract.
Right.
That could be over a specific number of years. It might continue over the rest of my life. It might continue over a joint life. If I'm married, I might choose to make sure the income lasts as long as either of us are still alive, right? That's depending on what options you choose, how you want to structure that contract. So when that happens with a non-qualified annuity, each payment is generally made up of two parts, okay? Part of that payment represents your original investment. So using our $100,000 as an example, the other part represents earnings, okay? So we use $130,000 that my annuity is worth $130,000. I put $100,000 into it. Again, since you've already paid taxes on the original investment, only the earnings portion is generally going to be taxable. So there's a term you may have heard called exclusion ratio. And I don't want you to remember that term.
Good, because I not heard that term. So go ahead.
So think of it. I just want you to think of it this way. So the exclusion ratio is simply the IRS's method of determining how much of each payment that I'm receiving is going to be considered a return of my principal, which is, again, generally excluded from taxation, and how much represents earnings, which are going to be taxable.
Okay.
Okay. And you don't necessarily need to know how that's going to be calculated. But if I were saying, hey, again, I put $100,000 in and I want this to pay me over the next 20 years. And maybe I'm going to receive $1,000 a month. So some portion of that $1,000 a month is going to be tax-free because that represents what I originally put into it. The other part of that $1,000 is going to be taxed, which represents the calculated earnings on that annuity.
Gotcha.
Okay.
Yep.
You got all this. You're going to be ready for the pop quiz next week, right?
No. I'm really trying hard to understand this. You see that.
And that's why, again, I don't know how great of a job I'm doing at trying to explain how annuities work, but just understand they are complex.
Well, yeah, a little.
And again, my hope as we wrap it up next week is as we start talking about some of the features and benefits, guaranteed income riders, guaranteed death benefits, some of these other terms that people have probably heard associated with annuities, they can be really valuable features as long as you understand what the costs are, what the fees are, and ultimately what am I getting out of this? Again, it's always starting with that. I always keep coming back to this question: what do I want this thing to do for me? What am I trying to accomplish? And then does this annuity feature meet that goal?
Okay.
That's the biggest thing I would take out of any of this is thinking about what am I trying to accomplish? Working with retirees a lot, it's especially if somebody's really disciplined in savings over their career, they were really good at saving money. They're not always good at spending money when they actually get to retirement, as crazy as that sounds, right? So sometimes you say, well, I just can't spend. I don't want to spend. I don't take any chances of losing it. Well, sometimes you might think, well, okay, what if you had guaranteed income, how would that change your mindset? How would that change your emotions about spending money?
Mm-hmm.
And if you said, well, you know what, if I actually had X amount of guaranteed income, I would probably feel much better about spending it if I knew it wasn't going to run out. That might be a situation where maybe we think about incorporating an annuity into our strategy or income strategy, right? But it still comes to understanding what is my objective? What am I trying to accomplish with this particular strategy, product, solution?
Okay. Are you going to talk about the fees next week?
Yes.
Okay.
We're going to tie it all together. Again, questions to ask, features, benefits, some of the other considerations you want to think about with annuities. So as we just get ready to wrap up today's conversation, back to our 3 questions we started with. First, where did the money come from? If it came from a retirement account, the retirement account generally is going to determine how it gets taxed, how the money gets taxed. If it came from money outside of a retirement account, that's where you'll often hear, again, talked about a non-qualified annuity, right? And it's the annuity, the IRS rules around annuities that determine the taxation. The fact that if I am taking withdrawals, the earnings must come out first, but once I reach my principal, that becomes tax-free. If I'm taking guaranteed payments, it's going to be split between principal, what I put into it, and the calculated earnings. Okay. So that's where the second question being, how do we plan to receive money back? So occasional withdrawals and lifetime income payments may be taxed differently because the money is coming back to you in different ways. Okay. And then finally, coming back to our key point is, why are you buying the annuity in the first place? So actually taxes are very important, but taxes alone shouldn't determine whether an annuity belongs in your retirement plan. It's the planning objective that always comes first. The tax rules simply help you understand how that decision affects you individually.
All right. I'm looking forward to hear about the fee structure. How much is all this going to cost me?
Well, again, it's always a trade-off. So there's, again, you think about, and again, we'll touch on this next time, but again, there's nothing ever inherently wrong with fees. It's, am I getting the value out of paying whatever that fee might be? Whether it's, again, what is my priority? Is it a guaranteed death benefit, a guaranteed income, principal protection, whatever it is your objective is, there's nothing wrong with paying fees if it helps you meet those obligations.
Okay.
Right?
Yep.
So hopefully this conversation made annuity taxation just a little bit easier to understand. Again, I know it's complicated, but be sure to follow our next episode or follow the show to tune into our next episode. And hopefully we'll bring everything together for you. We'll talk about the potential fees associated with annuities, some of the optional riders and features that annuities may provide, and most importantly, questions to ask before purchasing or even replacing an existing annuity, and how you decide whether an annuity truly fits within your overall retirement plan. Don't forget to download the free guide we've been talking about, Does an Annuity Fit Within My Financial Plan? You can find all the links and resources for this episode at thesimply.retirementpodcast.com. And until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
You've listened to Eric on the podcast and heard conversations about retirement income, Social Security, taxes, investing, and many of the financial and non-financial aspects that shape retirement for women. But you may still be wondering, what sets Blake Wealth Management apart from other retirement planning firms? The answer is quite simple. At Blake Wealth Management, retirement planning is about more than investments. Eric's passion for helping women comes from the strong women in his own life, including being raised by a single mother and watching his grandmother navigate widowhood at just 62 years old. Those experiences continue to shape the mission behind this podcast and the work we do every day. Whether you are planning retirement with a spouse, navigating retirement on your own, or simply preparing for what may come next, the team at Blake Wealth Management is available to assist you with your retirement planning needs. Visit blakewealthmanagement.com for a free retirement assessment, or call 972-426-7237. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Blake Wealth Management and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.